So welcome to Avon Academy. So we are going to start the CFE lecture series online. So we are going to go with the first section, that is the financial transactions and uh, fraud schemes. Let's keep this thing down and ensure that everything is proper. So we'll go with one by one sections which are going to help you in revising the concepts before the exam. So this is mostly lectures which are going to help you quick revision before the exam. In addition to the prep kits that you are going to use it along with this. So the financial transaction fraud scheme, we have divided into 15 chapters. The first chapter is more about the accounting concepts. We'll go with the chapter by chapter. And the same thing you are going to see in the online recording lectures. So when we talk about the accounting basics part of it, we are talking about what are the things that we are going to see. We are going to talk about the accounting equation or the owner's equity part of it. So what is an owner's equity? What is the owner's equity? So it's assumed that you are going to have the basic understanding about um, the accounting basics, but still it is mostly for the fast and quick revision part of it. So owner's equity is nothing but it is your equity plus your accounting profits. Your accounting profits, which is also equal to your assets, right? Which are also equal to your assets minus liabilities. Assets minus liabilities. That's A means assets and L means liabilities. So that means you have a balance sheet out of the in the balance sheet. Let's say if this is your balance sheet, so you have two sides. One is a liabilities and equity, and another is assets. So from the total assets, if we take away the liability section part of it, what you are going to left is the equity section, equity value part of it. Okay, so and again in the basics, we are going to see the accounting method. Most of the accounting methods that we are going to use is the accrual basis of accounting. The cost, both has to be taken into consideration when we talk about the accounting methods. So it's more on the accrual basis. Accrual basis means once you are going to say, just to give an example part of it, once you are having a transaction, let's say you bought the mobile on credit. So if it is a cash basic system, the transaction is going to record only when you make the payment. So if you don't make the payment, how are you going to remember that the transaction has taken place during that period? So hence, accrual basis is something that's going to help you in reminding you about the transaction part of it. So hence most of the accounting methods are accrual basis, on the base of accrual basis part of it. So these assume that you are understanding about the accrual basis part of it. And then you have the gross profit. How do we calculate the gross profit? Gross profit is nothing but all the total sales that you have. The sales, or we say the net sales to be more precise, minus cost of goods sold. Cost of goods sold. That's how you get the what we say sales part of it. Okay. Then so there are many concepts in the accounting part of when we talk about the basic, assume that you know, like you have a going concern concept, right? So which you must have studied, going concern. So that means the company is going to stay for a longer time. You are not going to start a company just to wind up immediately. So it's a going concern. The people may come, people may go, and however they may go on forever. And the same way, you need to understand the basic accounting part of it. You know the three systems, right? You have the real accounts, you have the personal accounts. You have the personal accounts, and then you have the nominal part of it. Nominal accounts. So real account is something that you can feel it, you can see, touch it. That means the real account might come in, it might come in, or it might go out, right? It might go out. So when it is coming in, so you have to debit what comes in. You have to debit what comes in, and you have to credit what goes out. Let's say you are buying a mobile. So mobile is coming into the business. So you are going to debit the mobile, and what is going out? Cash is going out from you. So the cash. Okay. So when it comes to personal account, that is an individual part. When we talk about personal, like you, me, and others, like Ram, Sham, and other things part. So when it talks about a personal account part, so that means a person can receive it or give it, right? So receiver or giver. So for a receiver, we debit the receiver and we credit the giver, right? So when you are selling on credit, so who is receiving it? Your customer. So the customer's name comes on the debit side, the receiver, that's what the receivables comes in, and credit the giver, that is you. So you might credit to sales. When it comes to nominal, nominal means what? They are expenses or it can be incomes. So you're creating an account which is not in existence, like you cannot touch, see, feel it, kind of like employees, or we say insurance. So all the payments you cannot see, but you can make it, right? So here when we have, you have either expenses or losses. You have expenses or losses, or you might have gain or you might have gain or income part of it. So if it is expense, then you debit all your expenses. You debit your expenses and you credit the income. You got a point? So these are the basic accounts that you need to know when you're talking about the accounting basics part of it. Okay, so let's clear this one and we go to the next slide. So next we are talking about financial statements. So when we're talking about the financial statements, we are talking about what we are talking about. We are talking about the financial statements as per the GAAP, that is generally accepted as per the GAAP, generally accepted accounting principle. So here, and also the IFRS, that is International Financial Reporting Standards. So as per these financial statements, you need to prepare it. What are the statements that you need to prepare in the financial statements? One is your balance sheet. This is also known as a statement of financial position. So when we talk about the US market part of it, we have to identify this as statement of financial position or balance sheet. This is a statement of financial position. That means it is going to show the position of the company in financial nature at one particular point of time. You got a point? And then when you talk about financial statements, it's not just balance sheet. It's also about the profit and loss account, right? So that means we are talking about the P&L account, profit and loss account. So that means here you are going to share all the expenses and income of the company for that particular period. And then another thing that you need to show, mention in the financial statement prepare, is the changes in equity. That is the third statement is changes in equity, right? Changes in equity. Then you have the fourth statement that you need to prepare is your cash flow statement. Cash flow statement. Okay. Then you have other financial data. That is the additional part. These are the major mandatory statements that you need to prepare as per the GAAP, IFRS, and the other legal regulations part of it. Now let's go with the generally accepted accounting principles. Now let's go with the generally accepted accounting principle. So what is GAAP? One, it is an international financial reporting standards, right? GAAP is also a kind of a financial reporting standard that the companies has to follow, right? So GAAP is also an international financial reporting standard. That's like an IFRS part of it. Okay, let's see one by one. So one, it is a like an international financial accounting standard. Then it's a, let's see the qualitative characteristics part. What characteristics it has? One, it is relevance, right? Its relevance, predictability, okay. Then confirmatory. So when you talk about the relevance part, we are talking about that it is predictability and it is confirmatory. That means once you prepare the accounting principle, accounting statements on the basis of your GAAP principles, so it's confirmed that it is very much relevant, and it is also predictable. Then it is also materialistic, right? Materiality also should be taken into consideration when I talk about the GAAP principles. Materiality, because depends upon the materiality, your judgments are affected, right? Because the material aspect is going to be affecting your judgment. Because let's say for an example, you are going to put up a tender, right? So when you're going to put up a tender, if you are not going to get the information on time, it is going to lose the materiality. It's going to lose the materiality. So the judgment is going to affect the judgment. Then one, faithful representation. So when you are preparing it, so it's assumed that the details that has been presented in the financial statement, they can be trusted, right? Faithful representation part of it, because it is complete neutral and without any error part of it. So it is faithful representation. Okay, so let me clear these things. And then one, if I'm preparing the statement, if it is not comparable, so another quality that you have to keep in mind is the comparability and consistency. Comparability and consistency part of it. Because if you're changing your own policies regularly in preparing the statements part of it, how are you going to compare how the data is relevant and reliable part of it? So it's very, very important that you are creating those standards and ensure that reliability and comparability and concerns are being maintained for a better disposal. Otherwise, the disclosure will lose its value. So, and another feature or a qualitative aspect, that is verifiability. Verifiability. Okay, because if it is not verifiable, how are you going to get the consensus of your board or the shareholders part of it to agree that whatever you have shown in your statements, they are true and fair? So that's where the verifiability comes into place. And another qualitative aspect of the GAAP principles is timeliness. So if you are not providing the information on time, it's going to lose its decision-making power part of it. Because if you don't give the information on time, how are you going to make a timely decisions? And then understandability. Again, this is another feature important for making decisions. Okay, because timeliness and understandability very, very important. And last is the GAAP assumes that the the entity is a going concern, which we already covered a while ago, that the company is going to here for a stay for a long time, right? So the company is here for a long time. So these are the basic qualitative characteristics the company should have, which is following the gap principles part of it. Let's see the next one. Then apart from the qualitative aspect, gap also has the recognition, right? So gap also helps you in recognizing it, right? Recognizing. So all the financial statements that you have, right? So you have different elements in the financial statements and your income statement part, right? Like your assets. So how do you classify one is an asset and another is not an asset? Let's say, for an example, I might be running an academic institution part where the furniture is an asset because it is not my regular course of business to sell and keep furnitures. But the same furniture for furniture shop, it is a regular operating transaction, not an asset, right? So the gap principles are going to help you in identifying assets, liabilities. Then the same way you have profit and loss. That is for the profit and loss, you have income and expenses. So you have to identify which transaction or which element is an income and which is not an income. So its gap is helping you in not only knowing what to mention, it is also telling you how you need to mention and identify those things. And again, you have the measurability. So that means gap is going to help you in measuring those elements, right? It is going to help you in measuring it. The 4 point in the qualitative aspect of the gap is measuring it. So how are you able to measure the financial elements? One is the historical cost. You can see this is how you can measure it, right? How much you have spent in the past. Because you have purchased for 8 rupees and today it's available at 10 doesn't make your cost price as 10. Understood? So you have to take the value at the historical cost. Next, current cost. Because this is going to help you in pricing the particular product. Then you have the realizability. How much it is going to fetch you in the market if I'm going to sell it. Realizable. There's a realizable cost, or we can say settlement value, okay, or residual value, we can say that. And then the present value. And the present value part of it. So these are the features that you have measured that are going to help you in measuring the elements or in the financial statements. Then you have the how you are going to depart. Let's say if I'm moving from the gap to another system of accounting principles. So when you're moving it, there are certain factors that you have to keep in mind. One is the professional judgment. Okay. One is the professional judgment. Second thing is the circumstance that you are in, that the company is in. Because what is a common practice that's going in the industry part of when we are talking about preparing the accounts, what does the industry is following? Okay, or what the sector or substance, immaterial, whether it's immaterial or not, whether I'm overstating it or not, whether it's unreasonable or reasonable. So these are different factors which are going to decide whether I need to move away from the gap principle as per the accounting or otherwise. So we are done with the chapter 1. Let's see in the chapter 2. Thank you.